Welcome to Video20D. In this video we're going to talk about how the operations of the partnership are reported for tax purposes. So let's start with Bikini Bottom Partnership formed with two partners, SpongeBob and Patrick. Both contribute $40,000 each and hold a 50% interest in the partnership. And let's assume the partnership earns the following: ordinary income of $10,000, long-term gains of $3,000, and tax-exempt income of $4,000. And of course, this would be split half and half between SpongeBob and Patrick. The problem is if the Bikini Bottom Partnership reports income of $17,000 to each partner, that'd be $8,750, then we will have a problem. And the problem we're going to have is that, let's assume SpongeBob has an ordinary tax rate of 25%. So that would apply to the $5,000 of ordinary income. But that means SpongeBob would need to apply a 15% rate for the long-term capital gains, and of course a 0% rate for the tax-exempt, his share of the tax-exempt income. So obviously failing to provide SpongeBob and Patrick with the correct information would end up resulting with a brand new partnership accountant. So what happens is when we report partnership operations, we report ordinary business income and loss, and then we report separately stated items. So ordinary business income and loss, think of that as the residual after we've separately stated each other item. So separately stated items, of course, share one common characteristic. There must be some form of treatment that is different from ordinary business income, or could be different from ordinary business income, on a partner's tax return, individual tax return, or corporate if the partnership has a corporate shareholder. So commonly separately stated items are things like interest income, guaranteed payments, net earnings and loss from self-employment, tax-exempt income, net rental real estate income, investment interest expense, charitable contributions, long-term capital gains, that's not on the list but it's there, Section 179 deduction, and some other things. So of course a partnership files a Form 1065. We've seen this before. This is the top part of the front page, and again it's like most tax forms, typically identification information. And then comes think of this as the meat of page 1. And the meat of page 1 is where you report ordinary business income. And you can see that down on line 22. That represents all the non-separately stated income and expenses of the partnership. So you take that line and you transfer it over to what's known as Schedule K. Now, Schedule K is just a schedule on the Form 1065. So remember, we're still at the partnership level. This is aggregated information. But if you look at Schedule K line 1, it says, well, that's ordinary business income from page 1, line 22. So all that information ends up right here on line 1. And then what you see are a series of separately stated items. So things like rental income has to be stated separately because it's often passive. How about guaranteed payments? We'll talk about those. Interest income, dividend income, royalties, capital gains, short-term, long-term, other types of gains, including 1231, Section 179 deductions down on line 12, charitable contributions, line 13A. These are all separately stated items that are aggregated at the partnership level, so the total partnership. Then what happens is each owner, of course, each partner needs their own respective share of each one of these items. That comes on a Schedule K1. Sorry, this is the bottom of the Schedule K, not that it matters that much. There's a few other separately stated items. So that comes on a Schedule K1, and you would note that Schedule K1 Part 3 is broken out very similar to Schedule K. So we've got some identification information, and then we've got each partner's portion of what was listed on Schedule K. So in theory, if you took up all the Schedule Ks and added them together, all the Schedule K1s, and added them together, they would agree to Schedule K. And you can see that by taking the Part 3 of Schedule K1, which is on the left, and you can line up each item with what's on Schedule K. So look, line 1, ordinary business income, that's what it is on the Schedule K. Line 2, net rental, That's what it is on Schedule K as well. Skip down to line 5. You bet. It's interest income on both the K1 and Schedule K. So they are mirror images of one another. I usually think of Schedule K as the parent, and then Schedule K1s as the children. You add all the children up and you get to the parent. Okay. Guaranteed payments are this unique thing. So partners who work for a partnership do not receive a salary. Now, that's not to say partnerships can't pay wages. They can, but they cannot pay them to an owner. So instead, partners are paid what's called a guaranteed payment, which is a fixed amount that's paid to the partner regardless of the profit or loss earned by a partnership. So they're treated as ordinary income by the partners that receive them, but they are deducted in computing the partnership's ordinary income or loss for the year. And these items are both included in ordinary business income, but they are also separately stated to the partner that receives them. So you don't get a Form W-2 to report your wages from a partnership. You get a K-1, and on that K-1 would be listed your guaranteed payments. So self-employment tax, when it relates to partnership operations, for the most part, all income from a partnership is treated as self-employment income by a general partner. Again, that's the ordinary business income, right? So the separately stated items often are not. The shares of that ordinary income when it comes to LLC members is a little bit unclear. The bottom line is even though LLCs have now been around for some time, we have yet to have really clear guidance from the IRS on when an LLC member has self-employment income versus non-self-employment income. So a few things that we do know are when you are applying the self-employment tax rules to an LLC member, if they have personal liability for the debts of the LLC, so if for some reason they've guaranteed the LLC debts, that their income is going to be treated as self-employment income. If they have authority to contract on behalf of the LLC or participated in more than 500 hours with the LLC's trade or business, then we're going to try to treat, or the IRS is going to try to treat all the income as self-employment income. That brings us to the end of Video 20D on corporate operations. Thanks for watching. Corporate partnership operations. Now thanks for watching.